Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based insights to help you master the game of building wealth. And thank you very much for listening in today, as always. And if you do enjoy the podcast, if you can share it amongst family and friends, that would be fantastic. Today, I want to talk about, what should you do if you've got an underperforming investment? And it's probably one of the more challenging things associated with investing because, of course, if all your assets are moving in the right direction, you've all got positive, really good returns, there's nothing really to worry about per se. But it's only when investments don't perform, particularly in the shorter term, that it obviously makes you feel uncomfortable because it's not in line with your expectations or what you hope for. But importantly, we're always taught to, track investment returns and to sell dud assets and to make sure our money is working hard for us and all those sorts of bits of advice, which are fundamentally sound, but, how do you apply them? And it kind of reminds me of a quote by Charlie Munger, who was Warren Buffett's business partner for many years. Unfortunately, late Charlie Munger passed away last year, I think it was. Anyway, he said the big money is not in the buying and selling, but the waiting. And the reality is that some investments just take time. They take patience, and some investments will certainly test our patience. But you've really got to know, when to hold them and when to sell and move on. And it's actually quite a skill to knowing when to do that with which particular assets. So most asset classes move in cycles. That's nothing new. We're very familiar with cycles. And so there's sort of three stages in a cycle, if you like, or three phases. The recovery phase. The recovery phase is when an asset class has probably underperformed more recently. When I say more recently, I would say over the last potentially 3 to 10 years, you get some level of sort of underperformance, but all the bad news is reflected in current prices. And if anything, the asset class starts to look cheap, but the fundamentals are starting to turn around. So you can kind of see green shoots of recovery. The market hasn't turned its mind to that yet, so it hasn't priced in the recovery. And that's a really good, phase in the cycle to make your investment. Once that recovery phase is underway, it tends to transition into kind of an expansion phase. And during an expansion phase, the asset class performs really well. So when we look at sort of shorter term investment returns, they start to look really good. And towards the end of that expansion phase, it can become a little bit overcooked. So that is, the market really starts to love it. There's a lot of good news. There's a lot of really positive sentiment around an asset class. And towards the end of that expansion phase, you're probably seeing asset values, fully valued or even potentially technically overvalued, which then transition into the third phase of a cycle, which is a downturn or bust if it really becomes overcooked. And this is when there's a shift in economic fundamentals or investor sentiment can sometimes trigger a downturn phase. And this is when, as I said, asset classes have become overvalued during the expansion phase, and then might experience a significant drop in price and certainly a significant drop in overall sentiment. And that can happen because there might be some fundamental factors that have changed: economic slowdown, recession, change in interest rates, those sorts of things, change in law, could be change in government. So there could be some fundamental things, or it could be just a general shift in sentiment. And of course, we don't really want to invest in a asset class towards the end of an expansion phase just before a downturn or bust phase because, common sense prevails, of course. Our returns are going to be pretty ordinary in that situation. And so these phases can last a long time. Those phases can be, so a recovery, expansion, downturn, those phases can last a couple of years or, even up to a couple of decades. As the famous economist John Keynes said, the market can remain irrational a lot longer than you can remain solvent. And really, the saying is never really bet against the market. And I'm interested to see that, there are some negative ETFs where you can take a negative position on the market. So that is, you'd invest in those ETFs if you think that market's going to drop. The problem with these strategies, so I would never go anywhere near it. The problem with these strategies is, as John Keynes can say, he says, those markets can remain irrational and go much further than really anyone could ever imagine. But it's important to recognize recognize the cycles, recognize when an asset class is in a particular cycle, and really to enjoy acceptable average, long-term average returns, you really need to be or hold an asset class for a full cycle. Now, that can be challenging because, as I said, sometimes those cycles last over 20 years. I'll give you some examples in a second. But the point is that if you invested, sort of partway or mostly way through the expansion cycle, then you finish the expansion, you've gone into boom bust, and then you might even be in recovery phase. The point is that you might not have any returns during that period of time. Now, that's unfortunate timing, but doesn't necessarily mean the investment is bad per se, other than the timing, of course, because you've got to hold it for that full cycle. So when looking at investment performance and benchmarking investment performance, it's really important to take that context. Where is the asset class positioned? Now, of course, we've got full control over where we invest our money, so I'm not discounting the importance of making sure, that we have considered where an asset class is in the cycle when we made the investment as much as we can, because sometimes these things come out of left field, but it's important to think about it in that context. So when we've got an investment that's not performing well, or at least performing below our expectations, the first question we must ask ourselves is the investment fundamentally sound? So in other words, does the investment have the core attributes or fundamentals to make it investment grade? And so putting aside recent returns and trying and sort of put yourself back into the financial position, the market position when you originally made the investment, looking back, was it a mistake? Now, you might argue it was a timing mistake. I get that. But put that aside. Really, let's focus on the actual investment. So let me give you an example. Okay, so between 2010 and 2016, a lot of people invested in investment grade apartments in Melbourne. Now, the unfortunate thing is, since 2010, the median apartment price in Melbourne between 2010 and now, so 14 years, has only increased by 2.5% on average over that 14-year time period, which is slightly below the CPI rate, so inflation rate, so no real growth in that particular market. Now, that median price, of course, includes a whole bunch of new apartments and a whole bunch of older style apartments. So I would actually say older style apartments have probably achieved less than 2.5% of growth. Now, I'm sure looking back now, anyone that bought an apartment between 2010 and 2016, looking back now, would go, yeah, okay, that was not a good investment in terms of timing. But if you have a look at the attributes of the investment, was past return strong? Yes, when you look at historic returns going back to 1980. So really for a 3-decade period, the returns were there, they were strong. Did they have a good land value component? Yes. Were they in desired location? Of course. Did they have all the attributes to demonstrate that there's more land value than building value? Absolutely. So the investment was fundamentally sound. Was a mistake was the timing, and whether you can read markets and understand whether they're at what stage of the cycle they're at, that can be more challenging. Sometimes, obviously looking back in with the benefit of hindsight, it can start to become obvious, but it's not always obvious at the time. Sometimes it is in different markets, and I've spoken about that previously, but it's not always obvious. Now, I just wanted to add to this. It's not really related to today's topic per se, but sometimes people look back and go, well, I shouldn't have bought an apartment back in 2010 in Melbourne because it's really been a poor investment. And I get that. What I should have done is bought a house. And unfortunately, which you would have been much, much better off if you had have done that, of course, just on percentage-based returns alone, let alone dollar value returns. But it's not really a fair comparison, because a lot of people back in 2010 might not have had the budget or capacity or borrowing capacity to be able to afford to buy a house. The holding costs would have been higher as well. And so it's not always a fair comparison. But I just wanted to mention that just as a bit of a side note, really, because no point beating yourself up. If that was your capacity, when you made the investment 10 odd years ago, well, it is what it is. It really then comes down to holding that investment for longer, which kind of brings me into sort of the next part of this, which is, okay, if you've decided your investment is fundamentally sound, then clearly the answer is just hang on. You need to hold that investment for a longer period of time. Now, I hear people thinking, Stuart, how long do I need to hold it? How long is long enough? Well, really, forever is the answer. You just don't know. Cycles, as I said, can take a long time. And if it's fundamentally sound, you will just kick yourself if you go and sell that investment and then read in the paper that, in 10 years' time, that investment is now worth, 2 or 3 times what you sold it for. Then you'll say, look, I did all the hard yards and I sold just before the market recovered. The idea is that, as long-term investors, we know some investments will perform really well in the initial years of ownership. Some will take much longer time, but if we apply a sort of rules-based approach to investing and we're investing for 20, 30, 40, 50 years, the longer we hold those investments, the higher the probability is the returns, the average returns over the full holding period will be very acceptable and help us achieve our goals. So let me give you some examples, for instance, because everyone's in love with the US stock market over more recent times, but if you cast our mind back between 2000 and 2012, so that 12-year period, essentially the S&P as an index didn't change between those 2 points. There was no capital growth, only dividend income, so maybe about 2% of income. Now, since the start of 2013, the S&P index has appreciated by over 12% per annum, over that sort of 12-year period. So we had one 12-year period of no growth and then 12-year period of more than 12% compounding, which is pretty substantial, of course. Now, over that entire 24-year period, so if you put the sort of flat cycle and the growth cycle together, you've got a return of about 5.9%, and that's just the index alone, plus maybe around 2% in terms of a dividend yield, which gives you a total return of around 8%. So if I made my investment in the US stock market at the beginning of year 2000, certainly over the last 24 years, I've got average returns about 8%. But the first 12 years, I had no growth return, only income return. Certainly shows when I have a period of underperformance at the beginning of holding that asset, I do need to hold it for 20 or 30 years to really enjoy the returns. Another more stark example is the Japanese Nikkei. The index, the Nikkei index in Japan, essentially fell between the year 2000 and only in 2022 did it reach the levels that it was at in the year 2000. So that's 22 years of no growth. Now, it's had a pretty strong recovery since 2022. So the last couple of years, 12% compounding. Who knows what the future will hold? But the first 24 years is essentially no capital growth. And if you had have invested in 2000, you would have, 10 years later, you would be sitting in a massive loss. Now, certainly timing is wrong, but, and we can have complete separate conversation about Japan and what's contributing to its stock market. But again, it does show that some cycles, some phases in the cycle, I should say, can last a very long period of time, sometimes 12 to 20 years, that long. And that's why Charlie Munger said that the big money is not in the buying and selling, it's in the waiting, because, really the markets reward patience. So what happens if you look back at your previous investment decision, you go, nah, that was a mistake. So let me give you an example. If I look back and go, okay, I bought this brand new apartment off the plan in Melbourne 10 years ago. I know that the broader market hasn't had any growth, and certainly my asset hasn't enjoyed any growth, but is it because, would I buy that apartment again if I had my time again? And, I've spoken about high-rise apartments and lack of scarcity, lack of land value component, those sorts of things. So I think we would conclude, no, it's not a great investment. So if you've made an investment, you look back, and we've got to be realistic and we've got to face the brutal truth here. Like if it's a bad investment, it's a bad investment, and we should really forget about our ego and just sort of cut our losses and move on. But then the next question to ask yourself, if you do look back and you go, no, that was a mistake, it's fundamentally unsound as an asset. Next question is, how important is it for you to sell it tomorrow? That is, do you have the luxury of being able to wait a few years to more strategically exit that investment? Now, some people don't have that luxury. So, for example, for some people, particularly if borrowing capacity is a restriction, they've got to sell that dud asset first before they can go and replace it with a better quality asset, for instance. Whereas if you're not in that position, if you've got a surplus of borrowing capacity and you can continue on and with your investment plan and make some better decisions, whilst at the same time letting this other asset, at least giving this other asset a little bit of time, then that's okay. You've got that flexibility. If you have that flexibility, what you can do then is decide, what phase in the cycle is that asset class and is now a really good time to sell. So, for example, the US market's doing really well. If I had some US shares that I thought were duds, I'd probably sell them in this market because, it's a pretty buoyant market. But for example, when we've got some clients that might have pre-existing investments, say actively managed funds that might be in emerging markets, for instance, I'm generally not a fan of actively managed funds. They tend to be expensive and the performance tends to be pretty poor. But selling those emerging market investments now is not ideal. Emerging markets are really cheap. When you look at the PE ratios in Hong Kong and Korea, for instance, they're about 10 times. China and Japan is about 15 times, which is really cheap when you compare it to the US market, which is trading around 25 times earnings. And I'd consider anything between 17 and 20 times to be fair value. So you could argue that Hong Kong and Korea are kind of half price, if you like. And therefore, even if I have an investment that's not really working at the moment, it doesn't make sense to sell it. In this market, we would want emerging markets to move into the sort of recovery and expansion phase, and then we could then sell those investments. And similarly, when our clients invest, have direct shareholdings, again, from this podcast, I'm not a fan of picking direct stocks. An evidence-based approach tells us that index investing is a strategy that has a higher probability of producing better returns. But when we have clients with direct shareholding, it's not like we just go and sell them all willy-nilly and just reinvest all the money into index funds. Instead, we take a strategic approach to sort of say, okay, is this stock fairly valued? Is it overvalued? What do we think the future returns are? Are we concerned about losing capital? And if we're in a situation where we think the stock is undervalued and we think it's a pretty good stock otherwise, we'll hang on to it and we'll gradually divest of it in the future. If we're looking at something that we think's completely overcooked, completely overvalued, of course, then we're going to take some profit off the table and move that money across. So it's not necessarily about saying, I've got these investments, I need to sell them and completely, kind of fire sell them, if you like. It's really about strategically moving on, having the context of what the broader market is doing, considering, where the asset is valued, is it intrinsically fair valued or under or overvalued, and then over time strategically moving on from those investments. An American billionaire fund manager is quoted by saying the single most important skill for being a good investor is to be very content not doing anything for an extended period of time. And in this context, doing nothing isn't actually doing nothing. Doing nothing is something and a very important skill when it comes to investing. And quite often I find, because markets are changing all the time, they change daily, right? And sentiment changes significantly too. Quite often there's a lot of stimulus out there that almost encourages us that we should make a change, that we should change our approach, or we should change our investments. And actually what you've got to do is try and resist that temptation. And that temptation is there and it's tested daily, and particularly from our perspective. So we have a lot of conversations internally in our team about what's happening in markets and quite often, even though they're quite complex and deep conversations, quite often our conclusion we reach is do nothing. But it's not easy. And I think, can naturally think and feel, if this has changed, we need to change something as well. But sometimes you do actually need to do something, and working out, if it's 1 time out of 20 that we actually do have to take some changes, making sure you get that decision right, that's really critical. And that's why I said it's a bit of a skill. It's a skill to have the patience to ride through markets, but it's also the skill to know, when should we make a change and when we shouldn't make a change. But hopefully that sort of summary about looking back at the original decision, is it fundamentally sound? And if it is, just hold. If it isn't, then you've got to look at strategically divesting and moving on from that investment. But hopefully that gives you a little bit of sort of context of the way we approach those decisions. Okay, let's get into some listener questions. The first one is Paul. Paul writes, can you shed some light to the extent which managing agent fees vary across states? I'm a landlord of property in Melbourne's inner northwest and also in Ipswich in Queensland, and found that the rates in Queensland are significantly higher than Sydney, 10.5% versus 7.5%, including GST. 10.5% seems quite expensive, or do you think it's reasonable given the compliance costs, etc.? It's a good question, Paul, that they do vary significantly. I actually pulled out my statement and had a look. I'm paying 8.5% in Queensland, so you're paying another 2% higher than what I am, which is pretty substantial, I would have thought. It's true that managing agents to manage an investment property charge a lot lower rate in Melbourne and Sydney. I guess there's more competition in those markets, and that you tend to be a little bit more in Queensland. I said 8.5%, and Perth's probably the highest, across, sort of nationally. So you can expect to pay around 10% in Perth, plus or minus here or there. I think property managing agents are certainly doing a lot more work these days than what they did maybe 10 years ago, although technology's helped them a little bit to get a bit of scale there as well in terms of paying the bills and doing the reporting and all those sorts of things. But, it's a really good question. Also, the fees are what you pay, value is what you receive. So, of course, I would prefer to pay a property manager a little bit more money if I'm going to get a better service. At the end of the day, they're looking after a very valuable asset, and so you can't always judge it on price. But I think, Paul, ask around. And quite often what we will do in our business is speak to the buyer's agent that you use. Typically, buyer's agents will have relationships with property managers, and they will know sort of who's who in the zoo and be able to point you in the right direction there. Okay, next one is from Vishal. Not really a question. Maybe it's more of a suggestion for a podcast episode on ESG investing, which stands at acronym Environmental, Social and Governance. Let's call it ethical investing, if you like. And Vishal cites a few different sort of positive attributes with ethical investing, sort of growing demand, if you like, performance and outperformance, risk mitigation, in terms of where your capital, regulatory landscape, of course, there's going to be greater focus on these sorts of things, and social impact. So I don't think I have done an episode on ethical investing, Vishal. So thank you so much for the recommendation. I will add it to the list. I think it is worthwhile to look at it. Just generally, I guess, a couple of observations. I think it's true that putting the ethics aside, because let's just look at the investment fundamentals, because the ethics element, you as the investor, the ethical investor, needs to provide that overlay. For some people, that's going to be really important. For other people, it's just a nice to have, and that's not something I can advise you on, of course. So let's just think about then the financial considerations. I think the reality is the businesses that are more in tune with the environment and the sentiment around that, and also then the regulation, will attract greater capital. And where, capital flows, typically returns follow. So I think as a investment methodology or thesis or idea or thematic, ethical investing makes sense because we think all the capital is going to go there. When you look at returns, so sort of ethical funds versus non-ethical, and quite often there's a lot of index. I mean, Vanguard do it, Dimensional do it. So there's ones where you can say, we'll use the same approach, index approach, but one will have an ethical filter. Typically, ethical has outperformed, so the returns will be there. What I might do is I might plan to produce that episode next year, because I think it'll be interesting, because there's a lot of talk with Donald Trump winning the US election. What impact is that going to have for ethical investments, given that Trump's policies tend to be kind of, not pro global warming, and so that could sort of expose them to the change in political landscape. But anyway, Vishal, good suggestion, and of course if anyone listening has suggestions on any topics, I can't promise to produce them, of course. If I don't think it's something that is in my wheelhouse or suits the podcast, I can't do it. But if you do have any suggestions, love to hear from you. Okay, next question is from Pearl and Nick. They write, my partner and I are facing a bit of a real estate dilemma, and we could really use your advice. We bought our first house back in Sydney back in 2021. Yep, peak market vibes. And after some renovating, it's now renting out for $1,200 a week with a 4% gross rental yield, which is pretty healthy, so well done on that. Now we've got $100,000 saved up, and here's the crossroads. Should we throw that money plus some equity into building a $300,000 granny flat on our property and bump up the rental yield to $1,400 a week, so an extra $200 a week, and that will increase the yield to 4.7%, or should we use our savings and equity to put a $170,000 deposit on a second investment property for up to $600,000? We can't decide, so help us break the tie. What would you do if you were in our shoes? Thanks in advance for your wisdom. Pearl and Nick, I'd like to know your ages, but let me give you some assumptions here, or give you some parameters. Because if you said that you were quite young, say in your 30s or something, which means that you've got many decades to, build wealth, I'd probably say go for another property, just because you end up buying more land rather than spending the money on improvements on your existing land, and that's more likely to generate a really good return. If you, and I suspect you said it's your first time, so I suspect you are young, so that would be my answer is, when you're young, the goal is to acquire as many growth assets as possible, and then kind of when you've maxed out your capacity, either from a cash flow perspective or from a borrowing capacity or from a risk appetite perspective, then you turn your mind to, improving the income on those assets. And so if you're young, it's really about more growth assets, more capital growth, and that compounding capital growth over many decades is what's really going to do the heavy lifting in building a lot of wealth. The extra $200 a week isn't really going to change things that much, because you're not going to get the compounding growth that you will from buying a high land value asset. So since you've renovated and you've got a 4% yield from your first property, I would say use the budget, buy a second property and spend that $600,000 mostly on land value. So don't worry about the dwelling so much. You can always change the dwelling in the future in terms of renovate it, improve it, and improve the income profile. But really, if you're young, your goal is to build those growth assets. Great question, Pearl and Nick. Of course, it's not advice. I haven't got all your details, which is not to invite you to send me a huge email of all your details, but I think I've made some reasonable assumptions there. At least you understand the thesis around why I have reached that recommendation. Okay, last question today is from Eric. Eric says, I absolutely enjoy the Q&A episodes, lots of gold nuggets and invaluable information. Thanks, Eric. I've enjoyed, I keep saying, I've said it many times, I really enjoy the Q&A too. I think they're really fantastic, thought-provoking questions and enjoy answering them. So thank you very much for sending in. Anyway, Eric's question is, when would you recommend investing in super versus outside super in shares? For context, we have 4 properties, 3 investments, and 1 home. Between myself and my wife, we're in our late 30s. Assuming we have a combined income of $450,000 pre-tax, $350 for one plus $100 for the other, would it be better to maximize the super contributions each year for both of us in order to claim a tax deduction? Would you only consider investing in shares outside of super when we've maxed out our concessional contributions and still have surplus cash flow? That's a really great question, Eric. You're in your late 30s, so you can't access super for another 20 years. So locking all your money up inside super, you just want to be really careful about doing that. But the tax benefits are attractive, and getting money into an environment that will ultimately be tax-free in retirement is also really attractive. But you can probably do it in 2 parts pretty effectively. And so what my preference would be is to build most of my wealth outside of super first, but with an eye to or a view to moving it towards super and becoming more super focused as you get closer to 60. So I reckon for the next 10 years, so late 30s until you're late 40s, would certainly the higher income earner that's on 350, I'd certainly maximize that person's concessional contributions, but you're probably already doing that anyway, assuming you're employed or you're an employee, not self-employed, through the superannuation guarantee contributions, so the mandatory contributions. So in that situation, then I would probably invest outside of super. into the share market if that's what I wanted to do. And I think it kind of makes sense if you've got 3 investment properties and 1 principal place of residence. Obviously, you'll be hopefully gradually repaying the home loan, the non-tax deductible home loan. And then what I'd be thinking is, well, if we can get you to have a nice pool of assets by the time you're in your 50s, and hopefully, between 50 and 55, so, the first part of your 50s, then that can potentially build a little bit of a buffer to allow you to either partially retire or retire in full before you can access super. Whereas if you're too focused on super, you're not going to have that ability because you can't get access to it. And so that's the approach that I would take. Now, if you were much closer to 60, so if you're in your 50s, I would probably say let's really focus on super, because as you get closer to that period of time, the chances of your situation materially changing that would put you in a situation where you'd regret making those super contributions is pretty low. But when you're in late 30s, a lot can change over the next 20 years, and you really want to have as much flexibility as possible. Now, I've done an episode about, it's called A Third Super Fund. So if you just Google Pro Solution Third Super Fund, you'll find that blog and the episode that goes along with it. And I talked about having like an investment company and building up an investment company. And the benefit of that is you always get a credit for any tax that you pay, which means I can essentially put a whole bunch of wealth, or you can, Eric, put a whole bunch of wealth into a corporate environment and then gradually move it out of that environment into super, and do that really tax effectively. And potentially, if you move it out over many years after you're retired, potentially end up not paying any tax because you always get a credit for the tax you paid. So, of course, that's not advice, but that's the way I would look at it in terms of giving you the maximum flexibility. But great question, Eric, and thanks so much for sending in. If you have any questions that you want me to answer, or Campbell will be joining me on answering, the senior advisor that I work with, will join me answering some of these questions as well. Just send them to questions@investopoly.com.au. And until next week, bye for now.